If you're thinking about selling your agency, you need to understand what drives your business's valuation so you can get the best price possible. My name's Rayhan Mogul. I'm a chartered accountant, a founder of Sidekick Accounting, and an agency CFO. In this video, I'm going to talk through the steps you can take to increase the value of your agency and also to make it more attractive to a buyer. The first thing to understand is that the valuation of an agency is based on two factors. The first is your EBITDA, which is your profit before interest, tax, depreciation, and amortization, and a multiple. The multiple is a number that reflects how much more than your profit a buyer is willing to spend on your business. So that means there's two ways to increase the value of your agency. One, make more profit. Two, make it more attractive to a buyer with more future potential to increase your multiple. Let's start with EBITDA. I'm going to give you 5 steps you can take to make your agency more profitable over the long term to ultimately increase that valuation. The first is good financial management. Start by getting control of your numbers. This means tracking every expense, managing your cash flow, and understanding where your money's going. A good handle on your finances will give you clarity to understand what you can do and where the levers are to increase profitability. The second is cost control, and every agency has unnecessary costs somewhere. Look for areas where your business is overspending. Maybe you've got subscriptions you don't use, you've got a team that's too big and has too much capacity, or you've moved to a more hybrid or remote model and therefore you don't need that office space that you used to. By cutting unnecessary costs, you'll keep hold of more of your earnings. Third is to look at your business model. Is it profitable and is it scalable? This means making sure that as you grow, your costs aren't increasing faster than your profit. You want to have a model when you've dialed in your pricing, your service, and your delivery so that you know adding more clients through the top results in a fixed amount of profit out of the bottom. Number 4 is to benchmark yourself against other agencies. This means comparing your profit, your cost, your efficiency, and other KPIs against the top 1%. So you can see where the opportunity lies for you. By doing this, you'll have a really clear idea of where you're lagging behind and where the opportunity lies. And then take this and build it into number 5, which is a financial plan. That financial plan should involve assumptions around new business and revenue growth. It should involve assumptions around the team that you need to deliver that revenue and any other costs that you might incur in getting to that point that you want to. The idea of this financial plan is so that you've already done all of the thinking for the next 12 months that detail exactly when you need to hire and what you need to do in order to remain profitable throughout that period. Then the real magic comes from taking that financial plan and measuring your business performance against it every month. This level of financial control and management will help you make adjustments every single month to your strategy so you're never far off track from that goal that you set. By focusing on these areas and following these steps, you can increase the EBITDA of your agency, which ultimately will increase the foundation on which it's valued. Now let's move on to the second part of the valuation equation, which is your multiple. The multiple reflects how attractive and sellable your agency is. Here are 5 steps you can take to maximize your multiple. First is to build a business that's not reliant on you. Buyers want to know that the business will continue to run smoothly without you. If your agency relies heavily on you to function, it introduces risk, which ultimately reduces the amount someone's willing to pay for your business. To get a higher multiple, you need to make sure your business is transferable and doesn't rely on just one person. This means putting in place a system, processes, and team that can continue to run in your absence. Second is to develop robust systems and operations. Create clear processes and SOPs that show how everything is done in your agency. This could be anything from how you onboard clients to how you deliver a campaign to how you offboard a client. By having everything documented, you're instilling confidence in that buyer, you're reducing the risk that sits on them, and ultimately increasing the value of your asset. Third is to build your intellectual property out. This is what makes you unique and what makes your agency stand out. This is the specific way you serve your clients. It's the tools that you use. It's how you deliver results. It's what makes you stand out from your competitors. The more unique and non-replicable your approach is, the more a buyer is willing to pay. Fourth is your team and your leadership structure. Buyers want to see that you have a team that can carry your business forward. Invest in your team by providing training, having clear roles and responsibilities, and incentivizing them to stick around after the sale. There's loads of ways you can do this, but some options are share option schemes and profit splits that give them a slice of any future growth. Retention plans and bonus schemes will all act towards giving that buyer confidence that the team are going to stick around after the sale. And fifth is demonstrating good financial control and instilling confidence. Having solid financial records will increase your multiple. Buyers need to see that the business has been well managed financially for the years preceding that sale. Start preparing 3 to 5 years before you exit by keeping detailed management accounts on file. These management accounts tell the story of the business over the last 3 to 5 years, which gives that buyer more buy-in and more confidence in what they are putting their money into. They need to know that they can trust the numbers you've provided them, that they've then used for evaluation, and that they're getting a business with predictable performance. By following these steps, you can increase the multiple of your agency and ultimately increase the final sale price that someone's willing to pay. So to sum all of that up, you have a valuation equation. You have EBITDA times by a multiplier. By actively working 3 to 5 years out to increase both, you're going to maximize the valuation of your business when you eventually sell. If you found this video helpful, give it a thumbs up and subscribe to my channel for more agency finance content.